How Stripe obliterated traditional payment processing forever. 7 lines of code. That's all it took to destroy a $50 billion industry overnight. While PayPal was forcing customers through 17-step checkout flows and traditional merchant processors were drowning businesses in paperwork for 6-month approval cycles, 2 Irish brothers in their 20s quietly released an API so elegant that developers could accept payments in under 10 minutes. This is the story of how Stripe didn't just compete with the payment processing industry. They made it completely obsolete. The year was 2010, and accepting payments online was absolutely brutal. If you wanted to process credit cards on your website, you first had to apply for a traditional merchant account through your bank, which required 3 months of financial statements, personal guarantees, and often a personal credit check. Then you had to integrate with a payment gateway like authorized.net, which meant wrestling with documentation that looked like it was written in 1995, because it basically was. The integration process typically took developers 3 to 6 months, required understanding arcane protocols like SOAP and XML RPC, and cost upfront fees ranging from $500 to $5,000 before you processed a single transaction. Even after setup, you were hit with monthly gateway fees, statement fees, batch fees, and transaction rates that could reach 4% for small businesses. PayPal had simplified some of this complexity, but their solution forced customers off your website into PayPal's interface, breaking the user experience and causing cart abandonment rates to spike above 30%. For mobile payments, the situation was even worse. Most processors didn't even support mobile transactions properly until 2012. Then Patrick and John Collison, ages 22 and 20 respectively, dropped out of MIT and Harvard to solve this problem. The brothers had previously sold their first company, Octomatic, to Live Current Media for $5 million when Patrick was just 19, making him one of the youngest people ever to receive venture capital funding. But what made them dangerous wasn't their age or their previous success. It was their complete disregard for how things had always been done in payments. While industry veterans were focused on risk management and compliance complexity, the Collisons approached payments like a developer tools problem. They asked a simple question. What if accepting payments was as easy as adding Google Analytics to your website? In September 2010, they launched Stripe with a demo that let developers start accepting live payments with just 7 lines of JavaScript. No merchant account application, no gateway integration, no setup fees. You could literally be processing real transactions in under 10 minutes. The traditional payment industry initially dismissed Stripe as a toy for small startups. After all, how could a company founded by college dropouts threaten established players like First Data, which processed over $2 trillion annually, or Chase Paymentech, which handled transactions for half of the Fortune 500? The established processors had spent decades building relationships with banks, navigating complex regulations, and developing sophisticated fraud detection systems. They controlled the rails that connected merchants to the card networks: Visa, MasterCard, American Express, and Discover. But the Collisons understood something the incumbents missed. Developers were becoming the primary decision-makers for technology purchases, and developers valued simplicity above everything else. Stripe's API was designed with the same principles that made successful developer tools like GitHub and AWS irresistible: clear documentation, predictable behavior, and the ability to go from zero to production instantly. While competitors required merchants to understand the difference between authorization and capture, or navigate complex decline transaction codes, Stripe abstracted all of that complexity away. Their webhook system meant developers could receive real-time notifications about payment events without polling APIs or checking dashboards. Most importantly, Stripe handled PCI compliance automatically, eliminating the security audits and compliance costs that traditionally added tens of thousands of dollars to payment integration projects. By 2012, Stripe was processing payments for companies like Shopify, but the real breakthrough came when they started landing enterprise clients who had previously been locked into traditional processor relationships. Lyft was spending millions annually on payment processing fees and dealing with constant integration headaches as they scaled internationally. When they switched to Stripe, their engineering team went from spending 40% of their time on payment-related issues to less than 5%. Facebook chose Stripe to power payments for Facebook ads, citing integration speed and API reliability as primary factors. But the most devastating win came in 2013 when Twitter selected Stripe for their advertising platform, abandoning their existing enterprise payment processor despite having a multi-million-dollar contract. The deciding factor wasn't price. It was the fact that Twitter's engineering team could implement new payment features in days rather than months. Each of these wins created a demonstration effect throughout Silicon Valley. If Stripe was good enough for Facebook and Twitter, why was anyone else still dealing with traditional processors? The incumbents finally realized the threat around 2014 and launched their counterattack, but it was too late. PayPal rushed to release Braintree's developer-friendly APIs and acquired Venmo to stay relevant in mobile payments. Square, which had initially focused on in-person payments with their signature card readers, pivoted hard into online payments with Square Online. Traditional processors like Chase Paymentech and Wells Fargo Merchant Services scrambled to modernize their APIs and reduce setup times. First Data spent over $1 billion acquiring technology companies to rebuild their developer tools, but they were all fighting the last war. While competitors were trying to match Stripe's API simplicity, Stripe was already expanding into adjacent markets that traditional processors couldn't touch. They launched Stripe Connect, which let platforms like Kickstarter and Instacart handle payments between multiple parties while automatically managing complex payout scenarios. They introduced Stripe Atlas, allowing international entrepreneurs to incorporate U.S. companies and start accepting payments within days. Most importantly, they began offering financial services like business loans and banking through Stripe Capital and Stripe Treasury, effectively competing with the traditional banks that had previously controlled merchant relationships. The numbers tell the story of complete industry disruption. Stripe's valuation exploded from $95 million in 2012 to $36 billion in 2019, making it one of the most valuable private companies in the world. By 2020, they were processing over $600 billion annually, capturing market share from every major incumbent. Their revenue grew from $100 million in 2016 to over $7 billion in 2021, representing a 7,000% increase in 5 years. But the real damage to incumbents became clear in the public markets. PayPal's stock price stagnated between 2015 and 2020, despite massive growth in digital payments, as investors worried about Stripe's competitive threat. First Data was forced to sell to Fiserv for $22 billion in 2019, with analysts citing competitive pressure from modern payment processors as a key factor driving consolidation. Square's valuation remained heavily dependent on their Cash App business rather than payment processing, as their merchant services faced direct competition from Stripe. Traditional merchant processors lost their pricing power entirely. Average processing rates dropped from 2.9% plus 30 cents per transaction in 2010 to 2.4% plus 30 cents by 2020, with many processors offering rates below 2% to compete with Stripe's transparent pricing model. The second-order effects rippled through the entire e-commerce ecosystem. Startup creation accelerated dramatically because entrepreneurs no longer faced a 6-month payment integration timeline. The subscription economy exploded as companies like Zoom, Slack, and Netflix could easily implement recurring billing without building complex payment infrastructure. International expansion became trivial. Stripe supported over 135 currencies and could handle local payment methods like Alipay in China or iDeal in the Netherlands without additional integration work. This enabled companies like Spotify and Airbnb to launch in new markets in weeks rather than years. Mobile commerce finally reached its potential as Stripe's mobile SDKs eliminated the friction that had plagued mobile checkout flows. By 2019, mobile commerce represented over 50% of online transactions, compared to less than 20% in 2012 when mobile payment integration was still painful. The entire fintech boom was built on Stripe's infrastructure. Companies like Robinhood for stock trading, Coinbase for cryptocurrency, and hundreds of neobanks all relied on Stripe to handle the payment processing that would have previously required massive upfront investment and engineering resources. But Stripe's most devastating move was making payments completely invisible to end customers. While traditional processors forced users through clunky checkout flows that often required creating accounts or remembering passwords, Stripe pioneered features like automatic card detection, instant form validation, and one-click purchasing that reduced checkout abandonment from over 30% to under 10% for properly implemented sites. Their fraud detection system, Stripe Radar, used machine learning to approve more legitimate transactions while blocking more fraud attempts than rule-based systems used by traditional processors. This meant merchants using Stripe saw both lower fraud losses and higher approval rates, a combination that was impossible with legacy systems. Stripe's dashboard provided real-time analytics and financial reporting that replaced expensive business intelligence tools, while their automatic reconciliation features eliminated the manual accounting work that traditionally required dedicated finance staff. By 2020, many online businesses were processing millions of dollars through Stripe without their customers ever knowing or caring what payment processor they used, the ultimate sign that payments had become true infrastructure. The traditional payment processing industry that existed in 2010 is effectively extinct today. The model of lengthy merchant applications, complex integrations, and opaque pricing disappeared as completely as video rental stores or travel agents. Even the survivors were forced to completely reinvent themselves. PayPal acquired multiple companies and rebuilt their entire technology stack to compete with Stripe's developer experience. Square expanded far beyond payments into point-of-sale systems and business banking to differentiate from Stripe's online focus. The traditional merchant processors either consolidated into larger financial services companies or pivoted to serving only enterprise clients with complex requirements that Stripe couldn't easily address. But for the vast majority of businesses that need to accept payments online, the choice became simple: use Stripe or use someone trying to copy Stripe. The Collison brothers had achieved something that most companies only dream about. They didn't just win market share, they redefined what the market could be. Those 7 lines of code didn't just make payments easier, they made the entire previous industry obsolete overnight, proving that in the digital age, the best way to destroy a $50 billion industry is to make it completely unnecessary.